typically the kind of strategies that you're looking at, again, you're running a range of strategies. What kind of vol are they? And have you experimented with high vol strategies using AI, which tend to be longer term time horizon strategies? Because one of my beliefs is that it's much harder to compete with humans on a longer time horizon where you've got pattern recognition and that perceived living in the future and too many expected paths to get there for machines to deal with it yet. So have you looked at what kind of vols you have now, and have you ever looked at kind of longer time horizon and higher vol strategies to see what kind of return profiles you get out of that?
We have looked at higher vol strategies. Our strategies tend to be lower vol strategies, both in the long only and in the long short world.
Where's that? Is that the kind of 5 to 8 vol, or whereabouts in the vol?
So in the long only world, somewhere between 75 to 90% of the S&P type vol, and in long short, typically in the 4 to 8 vol range. Right? Obviously, that's regime dependent.
Sure.
The longer time horizon is actually pretty tricky. Right? As you extend the time horizon, right, the signal degrades, right? The noise tends to take over, and we haven't built strategies that do forecasting on a very long-term basis using AI. But we're far more focused on that 1 week to 1 month period where there's the potential for the algorithm to have a variant perception versus some of the other investors out there.
And that's one of the points I've raised to people who've been concerned that how do they compete with guys like you who have a huge experience, but are asking all the questions, have the tools, have the deep understanding of all of the makeup of the markets from a very granular level. It's very difficult for people to feel that they can compete in a marketplace. And one of my answers to people like that is be in the longer term time horizon, because then the only competition is humans. So, there's an edge there apart from people's brains against brains and luck.
I think that's good advice, and I'll elaborate a little bit on that answer. When you think of investing, I really break investing into 3 axes. Right? There's a pricing axis. You can be better at pricing an asset better than other people. Right? You can be better at pricing optionality better. You can be better at pricing yield better. Right? It runs the whole gamut. You can be better at picking people, right, for a venture capitalist, picking founders. The second axis I focus on is holding period, which echoes your point, right? And that goes from the very, very short term, the milliseconds in the high frequency world, to the multi-year horizon investors in the venture capital and private equity world, to the Warren Buffetts of the world who are saying they're holding things forever. And then the third axis I think about is liquidity. And it's distinct from holding period because there are some assets that are relatively cheap to get into and get out of. There are other assets that have enormous transaction costs, as well as you might not be able to find a buyer, right? It could take years to find a buyer for very bespoke asset classes. So if you look across those 3 axes, right, there are plenty of places to find an edge, right? And there are amazing investors in every corner of that 3-dimensional space. And I think investors need to pick their area, right, in that 3-dimensional space, understand their core strengths, and look to exploit those core strengths. And I know that's a very generic description, but the great investors that are featured all over the world have typically done that, right? Have focused on a specific area of that space and done that well.
Yeah, it's like Stan Druckenmiller did an hour-and-a-half interview on Real Vision a while back. And one of the things he talked about was he will only, when he's taking a big position, he will only use basically Eurodollars or bonds, bond futures, bonds, or currencies. Because in the end, he said, I can get out in milliseconds, 24 hours a day, and nothing else gives you that ability to manage risk. And so, and his expertise is knowing when to apply massive leverage into what is normally a low vol asset. It's super interesting. So just to finish off, I'd love to get your thoughts, because I'm a macro guy, and that means I live in the future. Where's this all going in 5 years? How do you see this space evolving? Because it's a very interesting, rapidly developing space, and it'll obviously splinter and morph as it goes. But where do you think it's all going?
I think we're going to see a convergence of the quantitative and the fundamental. I think, and there's going to be shades of gray throughout that. There'll be firms that are purely quantitative. There'll always be firms that are purely fundamental. And in the middle, you're going to see the adoption. I expect to see the adoption of more quantitative tools that influence the fundamental discretionary investment process, where you see the investment process potentially becoming more repeatable, less exposed to negative emotional biases. You're able to integrate more granular data. I think our understanding of investing and markets will increase over the next 5 years because we are able to use these models, use this data, use this compute to answer questions we never were able to answer before. So
that brings me up to one thing is, right now, there's the world of human behavioral investing, which is what basically you're exploiting. The alpha from understanding that, how people react around earnings numbers, whatever it may be, right? Now, as AI comes up and becomes a more dominant force, where does the signal come from? Because you're then competing against each other.
But I think that's back to the crowding point.
The Silicon Valley thing about AI is you get to a point where it takes over from human emotion. Not that we're saying that AI runs the portfolios, but they're all observing each other now and not observing the humans because there's less of that around as activity, which we've already seen with index funds, for example, have very prominent in the market versus the old value investors.
I think that crowding point is true for many of the innovations we've seen in finance over the years. And if we went back to the 20s, we could go in, document all of the strategies that got crowded, right? If we started in the early 80s, block trading at some point got commoditized and got crowded. Stat arb got crowded, right? Then you saw quantitative strategies get crowded, right? Long, short, market neutral had periods where it was crowded and became very aware of crowding to evolve. So, I don't think there's not a right answer, right? There's so many degrees of freedom in investing that as an area gets crowded, it potentially creates opportunities in other areas.
But do machines just trade against machines, I guess is the point. As we've seen retail volumes and other volumes falling, do we get to a point where it's you betting against somebody else's machine? Just philosophically,
Sure. In the high frequency world, I think you see that today. Yeah, right? In order execution and trading volume, you're effectively, it's algorithm versus algorithm to affect trades. For longer time horizon, I think that becomes a harder limit to expect because there will be variant perception amongst investors for many companies. If we all sat around a table to evaluate one company with all of the computers in the world and all of the data, we still could come up with 2 different answers or 3 different answers or 4 different answers. And I think I don't expect that to change. I always expect markets to evolve, and the emergence of AI as a tool will foster the evolution of markets.
Fascinating. All of this is fascinating to me because, hence I drilled you with a million questions because there's so much learning for everybody on what it is, because not only is it a whole different development going on, but what it also does is ask questions of us as investors, how we run our own processes. Are we asking the right questions? Are we doing the same thing? Are we observing the risk-adjusted returns in the right way within our portfolios? Because these are real questions. Just because it's a machine doesn't mean you shouldn't be asking it of yourselves if you're an individual investor too. So I just think, the whole thing is super fascinating, and I really appreciate you spending some time to explain it all. And I wish you the best of luck with it, because it's an amazing space to be in, and it'd just be very interesting to see how it develops over time.
Thank you very much. This has been a lot of fun, Raoul.